Every commodity you've heard explained on this channel, gold, oil, copper, trades on a spot market where the quoted price is roughly what people actually pay. Uranium breaks that rule completely. There are two different uranium prices at any given moment, and the one that gets quoted in headlines is almost never the one utilities are actually paying. If you don't understand why, you don't understand this market at all, and neither do most of the people making YouTube videos about it. Start here, because it's the single most misunderstood thing about uranium. When you see a uranium spot price quoted, that's the price for a relatively small, thin market. Utilities buying or selling uncontracted pounds, usually in smaller volumes, often through intermediaries and financial players rather than direct producer to utility deals. But something like 80 to 90% of actual uranium sold moves through long-term contracts, multi-year agreements, often 5 to 10 years, negotiated directly between mining companies and utilities at prices that are frequently different from spot, sometimes significantly higher, sometimes lower, depending on when the contract was signed. A utility running a nuclear plant isn't going out to the spot market every quarter to buy fuel the way an airline buys jet fuel. They're locking in supply years in advance. Because a reactor running out of fuel isn't an inconvenience, it's a plant shutting down. This is why you'll see headlines like uranium spot price crashes or uranium spot price spikes, and it barely moves what the big producers actually report in earnings. Cameco, the largest Western producer, sells the vast majority of its output under long-term contracts. The spot price is a sentiment gauge and a market for the margins. It's not the market. Here's the second thing that makes this market structurally different from oil or copper. Mining the raw material is only step 1 of 4, and each step is its own separate, concentrated industry with its own separate supply constraint. Step 1, mining, which gets you U308, yellow cake. Step 2, conversion, where that yellow cake gets turned into uranium hexafluoride gas, called UF6. This is the form uranium needs to be in before it can be enriched. Conversion capacity globally is genuinely limited. There are only a handful of facilities on the planet that do this at scale. Step 3 is enrichment, where the concentration of the fissile isotope U-235 gets raised to reactor-grade levels using centrifuges. This is by far the most capital-intensive and geopolitically sensitive step, and it's dominated by just a few players worldwide. Step 4, fuel fabrication, where enriched uranium gets turned into the actual fuel assemblies that go into a reactor core. A shortage or bottleneck at any one of these 4 steps can constrain the entire fuel cycle, even if there's plenty of raw uranium sitting in the ground. This is completely unlike oil, where supply basically means one thing: barrels extracted. In uranium, you have to ask, constrained where, before the question even makes sense. Mining is somewhat diversified. Kazakhstan is the single largest producer by a wide margin, with Canada and Australia well behind it, and Namibia and a handful of others rounding things out. But enrichment is arguably the most important choke point in the entire chain, and is dominated by a small handful of state-linked or state-influenced entities. Urenco, based across Europe and the US. Orano, French state-backed. China National Nuclear Corporation, that's self-explanatory. And historically, Russia's Rosatom. which for years supplied a meaningful share of global enrichment services, including to Western utilities. The last point matters enormously because it means Western energy security has, for years, run partly through Russian enrichment capacity, which is exactly the kind of dependency governments don't like discovering they have during a geopolitical crisis. You can understand why. That's a big part of why you've seen the U.S. and allied government money pouring into building out domestic conversion and enrichment capacity here in the United States. It's not just an industrial policy choice, it's a national security one. When a government is willing to hand out multi-billion-dollar loan guarantees for a mining or fuel cycle company, this concentration risk is usually the underlying reason. In oil, if prices spike, drillers can often bring new wells online in months. Uranium doesn't work that way. Permitting a new uranium mine, securing the environmental approvals, building out processing infrastructure, and reaching full production commonly takes the better part of a decade. Yeah, 10 years, sometimes even longer. So when prices were depressed for years after the Fukushima accident in 2011, when dozens of reactors worldwide went offline and demand collapsed, mining companies shelved projects and cut exploration spending. That decade plus of underinvestment doesn't just reverse itself because prices went up again recently. The supply response to today's higher prices and rising demand is still years away from fully showing up, which is the structural reason you keep hearing about a uranium supply deficit, even as prices have moved higher. On the demand side, there's an equally important quirk. Uranium fuel typically makes up a small single-digit percentage of a nuclear power plant's total operating cost. That means utilities are relatively insensitive to the uranium price itself. A doubling in uranium prices barely moves the economics of running an already built reactor. That's very different from, say, an airline where fuel costs are a massive share of the operating budget and price spikes force immediate behavioral change. So next time you see a headline about the uranium spot price moving sharply, remember, that's the visible tip of a market where most of the real activity happens in contracts you can't see, moving through a four-step supply chain with choke points scattered across a handful of countries, feeding a demand base that barely reacts to price and a supply base that takes a decade to expand. That combination, hidden pricing, concentrated geopolitics, and painfully slow supply response is what makes uranium behave completely different from any other commodity you've covered on this channel. And it's the lens you need before any uranium stock pick actually makes sense. Thank you so much for listening to this video. Please select another one here from the list. We've got a couple on specific uranium companies that I think you'd really enjoy. See you on the next one.